A company can report record profits and still go bankrupt. That's not a paradox, that's accounting. Earnings are shaped by estimates, adjustments, and rules. Free cash flow doesn't care about any of that. It just asks one question: how much? Actual cash is the business generating? That's what we're breaking down today. Exactly how free cash flow works, why Wall Street uses it over earnings, and how to calculate it on any company in under 5 minutes. Think about Enron. Through 2000, the company reported billions in earnings. Analysts loved it. The stock soared. Free cash flow told a different story. It was deeply negative. The business wasn't generating real cash. That wasn't an anomaly, it's a pattern. In 2022, nearly 40% of S&P 500 companies reported positive net income but negative free cash flow. They looked profitable on paper. The cash wasn't there. So what does that actually mean for investors? It means the income statement gives you a company's version of events. Free cash flow gives you a reality check. Free cash flow is straightforward. Take the cash a business generates from its operations. Subtract what it spends on maintaining or growing its physical assets, property, equipment, infrastructure. What's left is free cash flow. Free cash flow, cashed as operating cash flow. Capital expenditures. That remaining cash is genuinely free. The company can use it to pay dividends, buy back shares, pay down debt, or reinvest in growth. No accounting tricks, no estimates, just cash. Two components matter here. Operating cash flow comes from the cash flow statement, not the income statement. It reflects real money in and out of the business. Capital expenditures, or CapEx, appears either on the cash flow statement or in the footnotes. It's what the company spends to keep its assets working. Earnings per share gets headlines. Free cash flow determines survival. Here's why. Net income includes non-cash items: depreciation, amortization, stock-based compensation. These reduce reported earnings without touching actual cash. Conversely, a company can book revenue before it collects it. That inflates earnings. But until the customer pays, there's no cash. Free cash flow cuts through all of that. It measures what actually arrived in the bank. So what does that actually mean in practice? A business with strong free cash flow can self-fund its growth. It doesn't need to constantly raise debt or dilute shareholders. It has options. A business with weak or negative free cash flow, even if profitable on paper, is dependent on lenders, on markets, on conditions it can't control. Apple generated approximately $99 billion in free cash flow in fiscal year 2023. That's after all capital expenditure. Pure excess cash. That's why Apple has spent over $600 billion on share buybacks over the past decade. The cash never stops coming. Compare that to Amazon in 2022. Amazon reported negative free cash flow of roughly $12 billion that year. Not because the business was failing, but because it was investing aggressively in fulfillment infrastructure. That's a critical distinction. Negative FCF during a high investment phase is different from structural cash burn. Amazon's FCF recovered to positive $35 billion in 2023. The infrastructure spending created lasting earnings power. The question to ask is always, why is FCF negative? Is this growth investment or operational weakness? You don't need a Bloomberg terminal. The data is public. Step 1. Go to any company's investor relations page or SEC EDGAR. Pull the most recent annual report, the 10K. Step 2. Open the statement of cash flows. Find net cash provided by operating activities. That's your operating cash flow. Step 3. In the same statement, find purchases of property, plant, and equipment, or similar wording. That's your CapEx. Step 4. Subtract CapEx from operating cash flow. Done. You've calculated free cash flow. For faster research, macro trends, wise sheets, and simply Wall all display this automatically, but knowing how to calculate it yourself means you understand what you're looking at. Mistake 1. Confusing FCF with profit. Profit is an accounting number. Free cash flow is a financial reality. A company can have both, neither, or one without the other. Never assume they move together. Mistake 2. Treating negative FCF as automatically bad. As the Amazon example shows, high-growth businesses often run negative FCF by design. The question is whether the investment is generating future returns. Look at the trend over 3 to 5 years, not a single quarter. Mistake 3. Ignoring stock-based compensation. Many analysts use a version of FCF that adds back stock-based compensation, but SBC dilutes shareholders. It's a real economic cost. The cleanest version of FCF keeps it in. Mistake 4. Only looking at the number, not the yield. FCF of $5 billion means very different things on a $20 billion company versus a $500 billion company. Always calculate FCF yield, FCF divided by market cap. A yield above 5% is typically considered attractive. Below 2% warrants scrutiny. Since this is a concept clinic, the signal score applies to FCF as an analytical tool, not a single stock. Factor score rationale. Business. Quality 9 to 10 FCF is the most direct measure of durable cash generation. Valuation relevance. 10 FCF yield and P FCF are among the most reliable valuation inputs. Momentum. Signal 7 to 10 FCF trends are strong leading indicators of earnings. Revisions risk indicator 8 to 10 declining FCF is one of the earliest warning signs of distress sentiment. Alignment 70 to 10 institutional investors weight FCF heavily. Retail often ignores it. Total Kinnell score. 40-50 verdict. Free cash flow is as close to a ground truth metric as fundamental analysis has. Use it as your primary filter, not a secondary check. Here's the one thing to remember from this video. Earnings tell you what a company wants you to believe. Free cash flow tells you what the business actually produces. Before you look at a PE ratio, look at the cash flow statement. Before you trust a headline profit number, calculate FCF yield. That one habit will separate your research from 90% of retail investors. If you want to see the signal score applied to a specific stock, one with an interesting FCF story, it's going up this Friday. Subscribe so you don't miss it. And if this was useful, the next video in the Concept Clinic series covers the one valuation metric that actually predicts 10-year returns. That's worth your time.